Hello and welcome back to Equity, TechCrunch's flagship podcast about the business of startups. I'm Rebecca Bellan, and this is our Wednesday episode where we home in on a trend in the tech world and dive deep. Today, we're talking to Morgan Stanley veteran and former president and CFO of SoftBank Group International, Alok Sama. Alok is also the author of The Money Trap, Lost Illusions Inside the Tech Bubble, on sale September 17th. Alok, welcome to the show.
Thanks, Rebecca. Fan of the show and great to be here.
Yeah, I'm really excited to have you here. And there's so many things I want to pick your brain on. I don't know how we're going to keep it to 30 minutes, but I guess we're going to have to try. I'd love to hear your thoughts on AI. And to kick that off, let's put into context a lot of the news that's been happening this week in relation to Apple. So for our listeners, this week on Monday, Apple had its Glow Time event where it shared its iPhone 16 lineup, which will be the first iPhones to ship with AI-powered functionality. And by AI, I mean Apple Intelligence, Apple's own brand of AI. And then it will also have a partnership with OpenAI. And there's a lot to be discussed, a lot of promises that are coming out later this year. Alok, I wanted to get your thoughts on what was announced this week and how you think that's going to affect Apple coming into this AI race.
Yeah, I mean, there's so much written and said about AI and Apple that it's kind of tough to find anything original to add, to be quite honest. But to me, I mean, the comments I would make first generally on AI, I mean, one of the things I do is I'm a senior advisor to Warburg Pincus. You know, they are under the radar a little bit, but fantastic growth investors in the world of technology. And kind of steered away from investing in LLMs, et cetera, but very focused on AI, more as applied to their portfolio companies. And I think what they're seeing, and you go back to, rewind a week or a couple of weeks to NVIDIA's announcement and what Jensen talked about. He gave the example. I think he was talking about a telecom company, Amdocs, I think it was, able to cut its customer service costs by 30%. I mean, I think those are the sort of things that Warburg Pincus is seeing across its portfolio. So at the enterprise level, it's very real. It's not kind of nothing radical, nothing too sexy. I mean, it's kind of, you've got call centers and you've got AI and you've got AI replacing that. And the productivity improvements are very real. At the consumer level, it's very early days. I mean, I haven't seen any apps. For example, you go back, you talked about the iPhone. I vividly remember the first time I held the iPhone in my hand. And it was like, oh my God, this is seriously cool, right? Mm-hmm. I don't think anyone's really felt that when it comes to AI at the consumer level. I, for one, have great expectations in terms of how Apple, which has always been cutting edge in a consumer-friendly way, kind of bringing new technologies to all of us. But it's very early days. I mean, they didn't announce that much, right? I mean, a cooler chip, which my old friends at ARM will benefit from, kind of an energy-efficient chip with more processing power. And I think this theme of AI at the edge of the network, as opposed to in the cloud, will be an interesting theme once Apple and others begin to kind of adopt it. So I think it will be, in terms of what it does, we will see. Jury's still out, right? Yeah. I mean, you sort of see the potential, but, you go back to the early days of the iPhone. I mean, nobody really saw Uber or all of these things coming. So we will see. And, smarter people than I are betting tons and tons, hundreds of billions on something radical happening. But we shall see.
Yeah. So, you mentioned really quickly that ARM will be benefiting from this. If you could just break that down for our listeners, because, obviously iPhone 16, they're really focusing on this new chip. Yes. And I believe, is ARM producing that chip?
Well, ARM doesn't produce chips, ARM design chips. So I think the phenomena I'm talking about is AI at the edge of the network. And the edge of the network being cars and smartphones. It's less about fridges and toasters, which people talked about, and kind of how there's nothing particularly cool about that. But certainly the smartphone. I mean, I think that's something we are missing the palm of my hand. Cars too. So I think energy efficiency is really important, and that's always been ARM's edge. And ARM doesn't manufacture chips; they design chips.
Right.
So as a ARM design chips, which they collect royalties on, I think you'll see more and more of those more expensive ones at the edge of the network. And not to suggest that that's displacing or eating into what NVIDIA is doing, but NVIDIA's strength is in data centers, right? I mean, it's the $30,000 to $50,000 Blackwell Hopper. I don't know how they come up with these names, by the way. I mean, the chips that go into data centers that people like Microsoft Cloud and Google Cloud buy, right? I mean, I think that is more investing, arguably ahead of the enterprise, but it's the enterprise ahead of demand. But that's the enterprise market that they're after. I mean, the Google Clouds of the world, that's the market they serve.
Mm-hmm. Yeah. Obviously, we're seeing really high valuations in a range of companies in the AI space. Anthropic, I think, is pulling around 18.4 billion, OpenAI over 100 billion, XAI, that's 24 billion. And, we spoke last week on Equity about VCs having FOMO, trying to snatch up shares in AI startups on the secondary market. And a lot of those companies are commanding a 30% premium in secondaries. A lot of your book talks about hype cycles in venture capital investing. Obviously, a lot of people say we're in an AI bubble right now, but I'd love to hear your thoughts on that. Do you think we are?
Yeah, I think just talk about NVIDIA for a minute. I mean, if you look at NVIDIA and you look at the way it's performed, I mean, it's not disconnected with reality in terms of how their revenues and profits are growing, right? I mean, I think NVIDIA trades at somewhere in the region of, depending on what your projection might be, 35 to 40 times forward earnings. That's not outrageous. Outrageous was Cisco, which was trading at, if you want to go back and kind of look at history, Cisco was trading at 200 times earnings, right? If you'd invested in Cisco back in 2000, 25 years, 24 years later, you'd still be losing money, right? I mean, that's a real bubble. NVIDIA, I think, the worst thing you could say about NVIDIA, its competitive position is as strong as it's ever been. I think you could debate whether its biggest customers, and which is really the hyperscalers, I think that together account for 45% of revenues, the hyperscalers being Google Cloud, Microsoft Cloud. I think the exact number is 45% of revenues. Are those guys over-investing, investing ahead of demand, and is there a hiccup along the way? And since kind of public markets tend to focus on quarterly results, do you have an accident in terms of missed earnings? But that's not too radical, right? It might bring down the stock 10, 20, 30%, but that's not disaster. The company is it's on a tear. Its competitive position is as solid as it's been. I am somewhat bemused at the valuations in the private market. I think OpenAI is interesting. Now, OpenAI's run rate revenues, I think the number is 3.5 billion, which is terrific. And I don't know what their bottom line is. And obviously, if they're growing, they've got the profile. We talked about Apple. And as we know, Apple Intelligence is going to be powered by ChatGPT. That will unfold over time. And we see how cool and how people make money, how OpenAI makes money. Not obvious yet. What I'm intrigued by is, and again, we're talking about announcements of rumor deals as opposed to actual deals, is OpenAI being valued at 126 billion in its latest round, and the participants in that round, led by Thrive Capital, the participants being Microsoft and Nvidia. And what really struck me about that is the circularity, right? Because if you think about it, if you've got Microsoft investing in OpenAI, well, what does OpenAI need money for, right? OpenAI, apart from employees, which is crucial, obviously, AI engineers, very expensive. They're going to buy capacity. And where are they going to buy it from? Well, Microsoft Cloud. So the money goes to Microsoft Cloud. NVIDIA as an investor, what is Microsoft Cloud going to do with the money? Well, they're going to buy NVIDIA Blackwell chips or whatever else NVIDIA comes up, right? I mean, Jensen's he's on an annual upgrade cycle. So it's money literally round tripping. That's not to suggest anyone's doing anything that is even borderline illegal or whatever. Absolutely not. But it is interesting to see, right? Because you've got money coming from these investors, goes into the company and goes straight back to them. Thrive led the last round at 86 billion. Very unusual to see VCs leading follow-on rounds. Now, the last one at 86 was secondary. This one's primary. But still, VCs generally have a preference for seeing other people lead follow-on rounds. Their LPs and VCs themselves like to see validation, independent valuation. So I kind of wonder at that and wonder if it's overdone in all these SPVs, which you alluded to, that are being created. I'm a pass on those. I mean, I could be wrong. I've been wrong before. I usually am when it comes to some of these hyper growth opportunities. But there you are. I mean, I don't think in the public markets we're in a bubble, kind of summarizing.
Yeah.
But we're seeing some unusual, bubbly sort of things in the private market.
Okay. So kind of a bubble. I mean, in the public markets, not necessarily actually a bubble because the risk is really underinvestment, not overinvestment for a lot of the public companies. But then meanwhile, within the private sector, and I guess probably that overlaps into the public sector, maybe less bubble adjacent activities, but also like an incestuous bubble where
it is. I think incestuous is the right word. That's right. Yeah. And the other thing you got to keep in mind, the people who are over investing, these are the smartest CEOs, Satya Nadella for one. I mean, they know exactly what they're doing. And they're flat out, when, Satya on his last earnings call, kind of flat out said that the risk of underinvestment outweighs the risk of overinvestment. So they recognize they might be overinvesting. And, I think the number for Microsoft was 35. For Google, it was 25 in terms of what they invested in data centers. I'm talking about buying real estate and building data centers, which is expensive, capital-intensive business. But it's very different from the 2000 bubble, which I've lived through, and I was a telecom tech banker, mostly telecom. And, you had companies like Global Crossing, which is worth $100 billion. I mean, that went to zero. That was a public company that went to zero. So, you got investors who got hurt, and, that's a huge hangover. I don't see there's very little chance of that.
Right. So it's not like these nobody companies come out of nowhere investing all this money with insane valuations and then the valuations drop. This is like these companies have businesses in the bank. They are, they're pretty much untouchable.
They have, exactly, bulletproof balance sheets, not relying on leverage, hundreds of billions of dollars in cash, and they can afford to overinvest to the tune of $5 or $10 billion. I mean, it sounds ridiculous to talk about, be so cavalier talking about numbers that big.
I know.
But the reality is, a company like Microsoft, they know what they're doing and they can afford it.
Yeah. Well, you said that, no one's doing anything illegal here, but I wonder if the only companies are the ones like Microsoft that have all of the money to be able to spend and overinvest on AI, then you don't really leave room for competition.
Well, that is true. But then you also had deep-pocketed players like my old friend, my ex-boss, Masayoshi Son. He's out there, right?
Right.
You are seeing people, there's a company called Cerebras, which has gone public, which I happen to have a small indirect, actually one of those SPV.D's investment on. I think it's really grand to think of a company like Cerebras as a challenger to NVIDIA, but then similar to GraphCore. I mean, they are coming at it with a slightly different angle. GraphCore has this notion of an IPU or an intelligence processing unit. With Cerebras, it's these wafer scale. I mean, kind of each chip, very different from NVIDIA chips, for example, is the size of a kind of an individual pizza pie, right? So they're a little bit different.
Right. So kind of like what Tesla's said that they might do with Dojo, right?
Well, yeah, exactly. Yeah.
Wafer scale.
Yeah. So yeah, there are a couple of people coming at it with different ways, but I don't really, candidly, NVIDIA's position that CUDA software platform, the customer relationships they have, I mean, it is bulletproof. It's really solid.
Mm-hmm. Yeah. And you mentioned previously, before the call started that, in the past, a lot of the conversation had been about the public markets, actions that were going on in the public markets, but public markets have been a bit slow.
Yeah, let's just look at the numbers. I mean, you look at the number of IPOs, second half of 2020, the number was 480. 2021, it was 1,035. Now, 613 in 2021 were SPACs, right?
Oh, God, the SPACs.
We've forgotten about SPACs, but a lot of those SPACs merged with operating companies. And a lot of them were technology companies. And one of them, by the way, was WeWork. So you've seen companies, all of them, the way SPAC works, you go public at a $10 share price. In the case of WeWork, went to zero. Enjoy Technologies, $10 to zero. ViewGlass, $10 to zero. 23andMe went public at $10, trades at pennies now, right? So, the value destruction for all those companies, all those IPOs was massive. I mean, you have another company, which is a great company and it's doing well, SoFi, which I used to be on the board of, made a terrific company. Anthony's a great CEO. Went public at $10, stock traded as high as $20. Company's doing fine, but the stock's at $7 or $8. So the value destruction was massive. And you go back to the year 2000 when you had, 400 IPOs, which was massive at the time. It took almost 4 years for the market to reset. So now you've gone from number of IPOs in 2021 being over 1,000 to the number in 2023 was 150. First half of 2024 was 75, 80, right? I mean, so the IPO markets, they're not there.
Yeah.
ARM is the only kind of huge success story you could point to. But I think that once you see those markets open up, I mean, that kind of gets getting into a different subject in terms of what's going on in VC land and the recycling of capital. That's very, very different from the type of bubble you saw in 1999, 2000, which is all about public markets.
Just quickly, you seem to have a lot of ready stats about how many companies are going public. Do you have similar insights into M&A activity? Because one of the things that I'm curious to ask you about is whether the fact that going public it seems to be more difficult. So I wonder if investors are pushing their startups that they invest in towards M&A or towards being acquired so that they can have their exit, and if that's affecting, M&A rates?
Well, they will, and I don't have to answer your question statistics off the top of my head when it comes to the M&A market. But the other impediment to, and this is actually interesting, it's a little bit technical, but still interesting to talk about, and it's an impediment to a company, a private company going public, is capital structure and preference, right? I mean, when you've got deals done at very, very high valuations, unraveling those investors with preference, if you want to do a down round, are you going to go public at a lower valuation? If I'm an investor and I came in at a headline valuation that's 2x of where the company gets sold or goes public, and I lose my preference, or it has implications if the company is being sold, to how that pie gets carved up, that's a non-trivial impediment. It's a very big deal in terms of trying to figure out what you do with the business. So that's a lot of what's going on with boardrooms when you think about raising capital. And there's companies, funds created that are kind of offering all kinds of structured solutions to get around that, debt disguised as equity and so on and so forth. That's another interesting kind of phenomena that is kind of off our time, so to speak.
Yeah, you do bring up some of that in your book, and you go over the early rise of tech companies in Silicon Valley and how investors and tech companies both set a precedent of high valuations based on growth expectations and about scale at any cost. And I'm wondering, has that shifted at all? Or are we still kind of operating completely in that mindset of the growth expectations, setting the valuation of the company rather than revenue that's actually coming in?
It's tricky. I mean, there's an anecdote in my book, which is very interesting to talk about. And it's when Masa and I have dinner with Mark Zuckerberg. Masa had the opportunity to invest in Facebook at a $10 billion valuation. Now, Yuri Milner did that deal. Masa didn't. People don't think of Masa in that fashion, but that was a case of Masa Son having kind of real valuation discipline. But that came back to haunt him. And that's just the reality of tech investing. When you're talking about some of these technologies, and by the way, again, in the social media space, I wasn't personally involved in the deal, but when ByteDance came along, TikTok, Masa recognized that AI engine, how powerful it could be, how disruptive it could be to social networks, to Facebook. And he said, whatever it is, any cost, I want in, right? And he went in at 75 billion, which may have seemed an outrageous valuation at the time, but he's well in the money on that trade. So I mean, as a banker and business school, old school finance, discounted cash flow, etc., some of that really needs to go out that door, right? And I felt that working for Masa. I mean, remember early days of negotiating ride-sharing deals? These companies had negative revenue.
Right.
But again, Masa-san's thinking about a world where not just competing with taxis, he's thinking about a world where nobody owns cars anymore. And when something is that transformational, you don't get hung up on discounted cash flow and valuations. That's not to suggest you don't focus on business models, which again, it's two dimensions. I equally talk about when I'm in the middle of doing some of these other crazy deals or the boomer millennial thing. And, what are you talking about, man? Kind of when I ask about revenues and business models. So there's a lot of that too. And I saw a lot of that. You can't get carried away.
Yeah. Well, you really got to weigh it out because it seems like there's a pendulum swing, right? Of, there's been periods where it seems like investors have done no due diligence and they're like, sounds great. Oh, we work as a tech company? Sure, what? Why not?
Yeah, well, that's
right?
The FOMO thing. You get carried away and, kind of individual brilliance kind of transmuting into collective insanity. We've all seen that movie before. I've seen it before. I fall victim to it. And when you're in the middle of it, you sort of know it. What you can't predict is you have no idea how it's going to last, right? The other thing you talked about, which is also interesting to talk about, and, WeWork maybe is an interesting case in point, not to harp too much on Adam Newman. He's been beaten up enough by lots of people. But blitzscaling or scaling,
right,
that works brilliantly for platform models. But that's not like, it's a great concept. Reid Hoffman's going to make that part of everyone's kind of venture investing vocabulary. And Masa's embraced that too. But it works brilliantly for platform models. It doesn't apply across the board. To take up real estate, it's one building. It's local. It's a hyper-local business, one building at a time.
Right.
So you got to get away from that. You got to get much, much more granular about things like ROI and margins when it comes to a lot of businesses.
Yeah, so it's like software, that kind of thing works. But yeah.
Exactly. Infinite scalability, zero variable cost, right? I mean, that was Masa's kind of mantra. Well, that's the SaaS mantra.
Do you think that where, investors and entrepreneurs are starting to learn their lessons, or is it just, are we one more hype cycle away from getting into groupthink mentality and throwing caution to the wind?
Well, I think the answer is both. nothing I've said, I mean, every VC in the Valley, I think, will agree or would be acutely aware of everything I said. But there's always going to be, it's human nature, and I fall victim to it, I have to say. Whether it was 2000 or whether it's 2020, 21, I've been a victim too. It's human nature.
Yeah.
You just cannot legislate against it. People will get carried away and mistakes will be made. And a lot of people are going in. And again, it goes back to the fact that the biggest investors are, in fact, people who can very well afford to make mistakes. It's Microsoft and Google. And they've said it in no uncertain terms that the risk of underinvesting outweighs the risk of overinvesting. Very tough to argue against that when it comes to transformative technologies like AI or the way the internet was or the way smartphones were.
Now, to close out, I wanted to maybe get some predictions from you about future of AI and where we might find the next investment going into. But before I do, I just wanted to point out a really great quote from your book. And now this is right after you describe Elon Musk's increasingly aggressive and immature antics on Twitter and the literal, quote, dick measuring contest with Mark Zuckerberg. And you say, quote, with Silicon Valley man reduced to his pair of dangling appendages as the primary neural processor, women are our only hope in this race against AI. Do you still...
Yeah, I mean, that is something based on my experience on Wall Street, even more so than Silicon Valley, I completely believe in. I think male egos, competitive instincts are a reason things get overdone. And I genuinely believe that, a lot of what, the wokeness and DEI, et cetera, I'm not completely sold on, but I think more female representation at the CEO, at the executive level, at the board level, I think it's great for business. I think companies would make fewer mistakes and would be less likely to do stupid things.
I mean, I obviously agree. Is that something you look at when you're going to invest in a company? Do you take into account, the makeup of their board and of their executives to ensure that, there are women who are going to keep things level-headed and maybe put fewer beanbag chairs in the office?
Yeah, I'm not in a position, sadly, where I'm investing or doing anything at a scale where my opinions make a difference. But I genuinely believe, and I know that, my good friend and my boss through the years, Nikesh Arora, has built a fantastic business at Palo Alto Networks. And when we were building our investment team, that was certainly part of our ethos, investment ethos and hiring ethos in the Valley and elsewhere.
Okay, great. And then last thing, predictions about AI beyond, the ChatGPTs. How are we advancing? What's the next use case?
Use case, very tough to call. I just make a macro comment, which I do talk about in the book, and that's all I'm going to say. It's less about my opinion, but more about contrasting the view, sort of the Elon Musk view of the world in terms of the risk, we need to colonize Mars because AI might destroy the world. I actually don't really buy into that. I think the bar that we set for machines seems to be way higher than we do for humans. I mean, and it's ironic that Elon would say that because I think the greatest example is self-driving cars. There's tons of times where I trust a machine to drive way better than I do, kind of late afternoon, or if I've, God forbid, had a drink or a glass of wine or whatever, and it gets tougher with age. I'm much more in the Masa Son school of the world. I mean, one of the things Masa was working on when I first started working with him was Pepper, the empathetic robot. To me, I kind of subscribe to that vision of AI. It's a productivity tool at the enterprise level. And it's a productivity tool at the individual level too, but it's certainly an entertainment tool. I do think, which I also point and I feel very, very strongly about, is beware of those recommendation engines, because I really do think that's a risk, right? I mean, I think all those algos that go and tell you what to listen to, what to watch, or what to read next, those are dangerous. That's dumbing down the human race. That's the one thing I feel strongly about.
Yeah, it really is. Sometimes I'm like, I feel like I need a new couch. I don't know. And then I'll just search couch, and then I'll just let the algorithm tell me what someone in my demographic might like.
Right. I give the example of, it's lots of musical references in my book, but I give the example of Paul Simon and Graceland, arguably one of the greatest albums of all time. I mean, how did that come to him? Not because, Spotify, well, you didn't have streaming then, obviously, because someone told him to listen to whatever. It was because someone told him to listen to the street music of Soweto. And that's not something an AI algo would ever treat you. So Originality, original thinking, that's not how machine learning works. By definition, it works by replicating, predicting what happened next, what pixel or word came next. And that's not what humanity, that's not what creativity is all about. It's the essence of humanity. And I think we lose that once we start being slaves to these engines.
Yeah, definitely. And one other thing that you talk about a lot in your book, aside from great music references, is excellent food and wine experiences. And I am extremely envious of the life that you've gotten to live and the places you've eaten.
Thank you. No, it was fun. It was a blast. It was a great journey.
Well, I am so grateful for the time that you spent with us. I could talk to you all day. Thank you, Alok, for joining TechCrunch Equity. Yeah, where can our guests find you?
Oh, boy. I mean, you could find me on Twitter, on LinkedIn, or I'm around.
You're around. Okay, cool. Well, thank you again for joining us on the show. And to our listeners, you can find me at Rebecca Bellan on X and then at Rebecca Bellan_writes on Threads. And you can find Equity on X and Threads at EquityPod. Talk to you all Friday.
Equity is produced by Teresa Loconsolo with editing by Kel. Bryce Durbin is our illustrator, and we'd like to give a big thanks to our audience development team and Henry Pickavett, who manages TechCrunch audio products. Thanks so much for listening, and we'll talk to you next time.